What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be talking about the company 3M. This is a stock that I've been purchasing shares of now for a couple months, and the stock has fallen tremendously over the last year or so. So we're going to break down why is the stock falling, and we're going to see, is this a good opportunity to start buying shares? So let's get started with my checklist. First thing on our list is going to be, is the stock down or is it oversold? And if we look at the stock chart, you can see not only in the last 5 years is this stock down over 50%, but in the last year, this stock is down over 29%. So it's definitely been beaten down. The first one's going to get a check. Then the next thing we're going to look for is revenue and net income. And if we scroll up here, what we're going to see is that revenue has grown a lot over, this goes all the way back to 1985, but you can see consistent growth over all of these decades. So that is a great sign. Let me move this up here. Now, if we go to net income, what we will find is that it's similar, but it is not as attractive necessarily. So we still see some consistent growth, but it's a little bit more volatile, and it's just, the chart is not as nice as the revenue chart, but it's still going to get a check. So those two things are good to go. Next up, we're going to look at the PE ratio. Right now, it's trading at a forward PE of 12. And the first thing I want to bring up here is what type of PE ratio does this stock normally trade at? You can see here from 2010 to now, this stock has gone from a PE of 8 all the way up to a PE of 25. And you could say the average is probably somewhere around a 14 or a 15. So right now we're talking about a forward PE of 12, and we're talking about a trailing PE of 11.5. If we want to double check that, we can also scroll up here and see similar numbers, 11.3 and 11.9. So that, if we're looking back over the last 10 to 12 years, a PE of 11 or 12 is pretty cheap, especially considering that it has not been that cheap since, let's say, 2013. So it's been over a decade since the stock has been this cheap. That sounds like a pretty good deal. Now we're going to get into, there are lots of lawsuits going around. Mainly there's one about their earplugs that they issue to the military, and that's causing them, I believe it's costing them $500 million is the estimate. So that is a big chunk of money. This is a company that normally does about $4 to $6 billion of net income. So that is a decent chunk that they're going to have to pay out. Then there's other things like chemical wastes. But the bottom line is, I understand those are important issues, but are they long-term issues that are going to hurt this stock fundamentally 5 or 10 years from now? I don't believe so. So things like this have always happened to companies like this, where there's some lawsuit because they do something wrong, and then a couple of years later, everything's back to normal and they're back to making billions of dollars. So not something I'm really that concerned with, and that's why I've been purchasing shares. So that's number 4 is going to get a check for price to earnings. Now, if we look at this one, I thought long and hard about. This is the company innovative? Do they have a moat? This one is debatable depending on how you look at it. This company is over 100 years old. They own a ton of different brands. And that's one of the things I want to bring up here is, if we look at, where is it? Let's see, right here. This is something I'm going to consider a moat for them. They own over 32,000 patents. So that's something that stands out to me that I think sets them apart from other companies. Yes, there's other competitors and other companies that make similar products, but they might not have as many patents as them, or 3M owns the name brand. So here, I have one product right here. This product right here is made by 3M, right? Or is it on that side? Then there's other things like Scotch tape. There's things like, we can go ahead and look up their brands, but they own so many different types of products, from cleaning supplies to marketing supplies to office supplies, all these different things. So it's a very, it seems to me it's a very solid and consistent company. So I'm going to give that I would consider that a moat. That's going to get a check. Then is the industry growing? Yes, as I just stated, in all those different areas, they're going to, those are areas that are going to grow. People are going to keep buying Scotch tape and cleaning supplies. So that's not a big problem there. Same thing with electrical tape or whatever other type of products they make, earplugs, all these different things. Next up is the return on invested capital respectable? Well, this is another one that I had to think twice about, because as you can see, if we come down here to ratios, the return on capital employed is, it depends how you look at it. Because, okay, first thing right off the bat I notice is the average, or the middle of this chart, is probably about 7%, right? It's probably somewhere around 7%. So is that an acceptable number? I would say yes. Over the long term, I think the way this company arranges itself is, if they can, I think what they're doing is, even though they're having lower return on capital employed numbers than, let's say, a company like Microsoft, I think the business model is not going to be as volatile, right? It's not going to be as up and down. So that's where we've seen them be pretty consistent with being around 6 to 8% for an ROI. But now here's the thing though, from 2018, let's say 2018 to now, we haven't seen them it's been under 7% for almost 5 years now. And then this, these last 6 months, there's been some fluctuations of 0% there and then 11% there. So there's some fluctuations, but it sure seemed to level out at about 5%, which is not a great number. So that's why I gave this a no, because not only that, but if we look back over the last however many years, this first half of the chart, they're averaging 6 to 8% a lot more often than they're averaging 6 to 8% in the second half of the chart. So that's the only thing. I think there is room for this business model to be more efficient, whether that's acquiring better brands or however they want to manage their expenses. There's something they can do to make it better. Number 8, is the cash flow healthy? This one is also one that I looked at from many different angles, and I've decided that this is going to get a check for several reasons. So let's go to cash flow. And as you can see here, operating cash flow, we have 7 billion, 8 billion, 7 billion, and then a little bit under, we have 5.5 billion. So that's, not fantastic and not horrible, somewhere in the middle. Then we have other things like they're investing money. What I like to see here is for financing cash flow, I like to see that they're paying back debt, and 2, they are paying a very solid dividend, that's also on this list. But the cash dividends paid 3.3 billion in the most recent year, with 5.5 billion of operating cash flow. So that's fine. That means they're paying out a decent amount to their shareholders. And for a company like this, I don't really have a problem with that. And if we look at their free cash flow, you can see it's come down a little bit, but nothing crazy. I mean, there's different reasons why that might have happened for the last 12 months, but we're looking on a long-term basis. So that's how we want to analyze this. Let's see, if we scroll up here, can we find this? Free cash flow. As you can see, free cash flow, it's pretty consistent with the way it trends. It trends up, right? So that's a good sign. That's something we want to see. So that's going to get a check. Then we have diverse revenue streams. I pretty much explained this. All those different companies, brands, products that they own. That's going to make their business model more diverse. And, they've been around for over 100 years. They sell in who knows how many different types of stores. So they also do business to business and business to consumer type of products. So that's also more diversity. So that's going to get a check. Is the equity growing for number 10? Well, the equity has gone from, this is partly goes back to, there's lots of sentiment out there on the internet about this company going downhill, and I don't see it entirely. I will say their return on invested capital is average at best, but I will not say this company is going downhill, because as you can see here, another thing, their equity has been increasing because they've been paying off debt, and keep in mind, this is a 5% dividend paying stock. So equity's gone from 10 billion to 2019 to now 14.7. Right. Well, that was as of a couple months ago. So that's solid. That's good enough for me. Number 11, is the equity over 15% of the market cap? Yes, it's 22%. Number 12, is the share count decreasing? Yes, as we can see here, this is another great thing I like to see. They're buying back shares. So 2%, on average, 2% a year, they're buying back shares. That's good. Number 13, are insiders are big money interested. Insiders are not. They've only been selling for the last 2 years, pretty much. The last 2 years they've been selling. Now, who knows? They probably did that beforehand, knowing that the stock was going to keep going down. So that's irrelevant, though. I don't like to pay attention to what the insiders are. Just because the insiders are doing it doesn't mean it's necessarily that we should be doing the same. So that's something you always have to consider. Let's go down now. All right, next up we have but however, what I wanted to bring up was there are hedge funds and big money funds that do own the stock. So that is a good thing. Then we have, is the management team respectable? I put no. 1, because of that return on capital number, but 2, it's because of those lawsuits. That does ruin their reputation. Although I'm arguing that it's fundamentally not going to hurt the business over the next decade, it does make the company look bad, and they do suffer these short-term losses, right? So that's why I'm going to give that one a no, but that's the only problem there. Number 15, do they have more cash than their average income? No, they have $3.8 or $9 billion of cash, and their average income is around $5 billion. So that's getting a no. Number 16, do they have a healthy dividend? Yes, this stock pays a 5% dividend. And as we saw before, their payout ratio was, for this past year, it was a little bit over, it was probably 60%. But in other years, if they're doing $7 billion or $8 billion of net income, then, or operating cash flow, then that payout ratio is going to come down. It's only going to be 40 or 50%, which anything between 40 to 60% of their earnings, if they want to pay that out in dividends, that's fine. If it went up to like 80 to 100%, then that would be maybe a concern. But 60 to 40%, that's not a problem. Finally, is the company over 20 years old? Yes, it is over 20 years old. It actually was founded in 1902, so it's been around for over 120 years. So all in all, this stock will get a 14 out of 17 score, which is going to be considered a buy for me. And I think I started picking up shares, I want to say probably around $140, $130 a share. I've been averaging down as it's been going down. I might buy some more shares this upcoming week, but I think this is a solid play. And whenever you can get reliable companies that have been around this long and you can get them at PE ratios as cheap as this one, I think that's a good opportunity. So that's going to be my final opinion on this stock. Thank you for watching, and I will see you guys in the next video.